The 6 most important macroeconomic indicators to watch in 2024. In today's information age, it can be overwhelming to keep up with all the news and updates about the economy. However, there are 6 key macroeconomic indicators that will have a significant impact on the markets in 2024. By focusing on these indicators, investors can gain a better understanding of how the year will unfold. In the next few minutes, we will discuss these 6 indicators and their implications for the economy. Reverse repurchase facility at the Federal Reserve. The reverse repurchase facility at the Federal Reserve is an important indicator to watch. This facility currently holds over $1 trillion and serves as an overflow for excess reserves in the banking system. As the facility gets drained, it indicates that dollars are leaving and being invested in US Treasury bills. This shift in liquidity conditions will impact the borrowing options for the US government. Federal Reserve's balance sheet. The Federal Reserve's balance sheet is another crucial indicator to monitor. The balance sheet represents the assets owned by the Federal Reserve, which are primarily US Treasury bonds. When the balance sheet declines, it indicates that the Federal Reserve is either selling these assets or not rolling them over. This reduction in liquidity can have significant effects on the stock market, interest rates, and lending options. Total money supply. The total money supply is a key indicator that reflects the amount of money in circulation. A decline in the money supply, as seen since April 2022, can have implications for asset prices, borrowing costs, and inflation rates. Historically, a contraction in the money supply has been associated with economic downturns. Federal funds rate. The federal funds rate is the interest rate at which banks lend to each other overnight. While the Federal Reserve does not directly control other interest rates, it sets the upper and lower limits for the federal funds rate. Changes in the federal funds rate can influence mortgage rates, credit card rates, and other borrowing costs. Yield curve. The yield curve represents the interest rates on government debt with different maturities. An inverted yield curve, where short-term rates are higher than long-term rates, is often seen as a predictor of a market crash or recession. Monitoring the yield curve can provide insights into investor expectations and market conditions. Federal government deficit. The federal government deficit, which represents the difference between spending and tax revenue, is a critical indicator to watch. An increasing deficit leads to higher interest rates, crowding out other borrowing options. The growing national debt relative to GDP raises concerns about the sustainability of the economy. Conclusion. By focusing on these 6 macroeconomic indicators, investors can gain a better understanding of the market conditions in 2024. Monitoring the reverse repurchase facility, Federal Reserve's balance sheet, total money supply, federal funds rate, yield curve, and federal government deficit will provide valuable insights into liquidity conditions, interest rates, borrowing costs, and overall economic health. Understanding these indicators can help investors make informed decisions and navigate the market successfully. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.